Let me now bring on board Hiren Ved, Director with Alchemy Asset Management, to talk about his current market view and where he thinks markets are headed. Hiren, looks like markets are stuck between rock and a hard surface. For the first time, the bears are saying that we've not lost the battle.
Well, Nikunj, I don't think so. I think, I think we've had a phenomenal rise from the lows. And, it's important that markets consolidate the gains that they have made. Nobody expected that the markets would bounce back so aggressively. In fact, if you look at the data aggressively, in fact, if you look at the data of mutual fund flows, right, it's very indicative of the fact that the investors have been selling ever since for the last 7 months because they think that markets have run ahead of themselves. They want to book profits. They want to keep cash on the sidelines. No market tops out when you have 7 months of consecutive outflows. You can argue that some of that is being invested directly, but, my feeling is that the market's just catching its breath after a phenomenal rally.
So what is the best way to approach this market? Because if you know markets are headed higher and the economic cycle has started, so we definitely would be higher in 6 months' time and a year's time. Should one just wait it out, digest the volatility, ignore the daily movement? Because if you sell now, you may not get a chance.
No, absolutely. I think we've been telling investors that, do not wait for, making your investment decisions based on Nifty, right? I think what we saw was a classic first move of a bull market where the markets kept climbing the wall of worry. It is only once that move matures that people start to understand that it is not just a liquidity-driven rally, but there is an earnings support, there is reforms that's happening, that the economy is rebounding. I think I think to make money in this market, you need to take now a very strategic, 2 to 3 year view at least to begin with. And I think if you do that, I think every intermittent correction that we are seeing right now should be used as an opportunity to get into the market rather than trying to time it. And you're absolutely right. If you try to time this, you're going to be left behind. But let's also be very clear that when you have this kind of a rebound, it's quite possible that there may be extraneous factors that come in between which can lead to a sharp correction or a drawdown, right? I think we are so lulled into the fact that we've never seen a 5% plus correction on the Nifty. I mean, in the good old days, 8, 10%, 15% correction used to be a normal correction, right? So I think we should, go ahead with the fact that the markets could correct anytime. It's in the nature of the markets to correct. But I think I see a very, very bright future both for the economy and for the markets. And the best way to play it is to stay invested or use every fall to invest in the market.
Hiren, you always like to buy themes. So give me your best 2 themes, and not the headline themes like consumption or something on manufacturing. Give me with specific themes where you feel that for next 2 or 3 years a 15 to 20% growth is not a probability but a possibility. I'll say it again, not a probability but a possibility.
So Nikunj, I think that to some extent I feel we are, though every cycle is different, I think we are in a 2003 to 2007 kind of cycle, right? And I think that manufacturing is going to make a comeback the economic cycle is likely to revive dramatically, and therefore, there needs to be some cyclical element in your portfolio. But if I were to use one word, which I've been saying since early this year, is that everything that is digital and cyclical will do well, over the next 2 years, because and therefore, I think that IT services, or tech as we call it in India, is likely to do extremely well over the next 2-3 years. I know, people have spoken about it, but I think that people are still waiting for the confirmation that, that IT industry is on a structural tailwind. And I think, maybe this quarter and another quarter will convince investors that we are indeed on a structural tailwind as far as IT is concerned. And then all the sectors that didn't do so well, like autos, auto ancillaries, right? The cyclical sectors, even for that matter, metals. Generally we don't invest too much in metals. I think the last time I did that was in early 2002 when we bought Tata Steel. And I think the time has come that we should pay some attention, at least a small allocation to some of the so-called cyclical sectors that people have been avoiding for a long time. But, even without playing that, you can easily, there are other sub-themes like logistics, for example, or, you could look at autos, auto ancillaries. I think good quality companies there, leading companies there, will give you very good returns over the next few years.
Hiren, what according to you are the key pressure points? We've also seen the index, change its constitution over the last few months in particular. What going forward to you are the main pressure points, given that the economy is still wobbling back to life? I mean, all the recovery triggers have been, positive, but it's still a little uneven and will probably still take a couple of quarters to fully bounce back.
So I think the pressure points come from the fact that, we are experiencing some sort of a second wave, which is kind of going to a little bit hinder, again, the movement of people, though I think we're not going to experience anything like the lockdown that we experienced, in the early part of the pandemic. And also the confidence comes from the fact that we now have our own domestic vaccines. So I think hopefully by July, August, most of us, will get vaccinated, and therefore the recovery should gain hold. But I do believe that there are opportunities in sectors, which were more impacted by the pandemic, right? And I think those sectors could revive, whether it is hotels, airlines, discretionary consumption stocks. So many of them have not moved beyond the pre-COVID highs. So I think this year there could be an opportunity, maybe to some extent, the recovery could be delayed because of the second wave. But I think eventually it is likely to happen because, the big strong point about India is that we have our own vaccines. We don't have to wait for vaccines to be imported from another country. To that extent, we are lucky, and probably 2 or 3 more will get approved over a period of year. So I think, yes, the recovery is still uneven, but it's going to be, like they say, it's going to be a tale of two halves. I think it's going to be a tale of 2 years, right? So you have 2021, which got substantially impacted because of pandemic. Certain sectors didn't get impacted. There are certain sectors which got more than disproportionately impacted. They will benefit in 21-22. So I think you will have to, in many senses, take a block of 2 years, which is, FY21 and FY22, because, some businesses, will probably recover in the forthcoming financial year, because they got more than disproportionately impacted last year.
Absolutely. Hiren, I know you said it's time to look at some of these other pockets, but on IT, and a sector that has performed so well, continues to, and also continues to be very optimistic going forward, what would you suggest is the best strategy? Maintaining, some amount in your portfolio, would you call it any longer a defensive play, or would you perhaps suggest going further into some of the mid-cap names in IT, trying to find further value there if you're too late to enter some of the more expensive stocks? What would you suggest is the best strategy for an investor still looking to get into the segment?
So, I think with the new tailwinds in the IT sector, traditionally I've always heard, that IT is a more defensive sector. That's because growth rates over the last couple of years were moderate. But the defensiveness of the nature came from the business model, the strength of the balance sheet, the cash flow generation capabilities, and it was also a great hedge against any macro uncertainties, which generally leads to the depreciation of the currency, and you tend to benefit. But I think going forward, the benefit of being invested in the tech in IT is that it is both aggressive and defensive. I think it retains its defensive nature because of the quality of the business and the balance sheet and the kind of cash flows and return on capital that these businesses generate. And it is offensive because I think structurally growth rates have gone up. So if you're looking for growth, quality growth, I think you will get it in the tech sector. And I think absolutely, I think we are bullish on the large cap, but we are also bullish on very selective mid caps as well. And I think there are opportunities across the sector. We believe, we've had a very strong exposure to the ER&D segment, which includes stocks like Tata Elxsi and L&T Technology Services. But we also have exposure to large caps like TCS, Infosys, and LTI and HCL Tech. So, we continue to be very, very bullish on the tech sector, both across large and mid cap.
So, Hiren, with the exception of staples, looks like you are bullish pretty much across the board. You like metals. I know you own pharma. You have a constructive view on metals now, something which you've not bought in a long, long time. So, on the aggregate, you are quite constructive across the board.
Yeah, I think, Nikunj, I'm quite bullish. What you will keep seeing in this market is sector rotation, right? So, being kind of chasing sectors, but I think that we're going to see a broad-based recovery. The beauty is that we're going to see not only recovery in India, which means that there is likely to be a very solid recovery in economy-facing stocks in India, but because global growth is so strong, you will also see globally aligned export-oriented sectors also do very well, whether it is auto ancillaries, whether it is IT services. And in pharma, you have to be very stock-specific, right? So I think I pretty much, I think that if you look at the next 3 years, and we have a very constructive view on markets, we also have a very constructive view across sectors and across market caps. I think both, large, mid and small, everything will do well. The breadth of the market is likely to improve. I think we are moving away from a situation where in 2019 and early part of 2020, we saw the markets had become extremely narrow. In fact, in my 30 years, I've never seen a market as narrow as it was in 2019, where only a few stocks did very well. Obviously because we were reeling under, many issues, right from IL&FS to DHFL, the whole credit system had got frozen. But I think now that has changed and you will see a better breadth of opportunities going forward. So, I'm pretty much bullish across the board. And I think it's going to be back to stock pickers, for the next couple of years.
Great. Hiren, closing comments. I'm going to use Adani Group of companies just as an illustration. they have a lot of debt in them, but yet they've been massive wealth creators. You spoke about metals. Metal companies have a lot of debt in them, but you still like them. Now, for the better part of the decade gone by, we've used the following line: avoid companies which have debt, avoid companies which have a leverage. Somehow I'm getting a sense that fund managers and money managers like you are not averse to buying companies which have debt or which have a leverage.
So Nikunj, I think the trick there is you need to understand what the future business plan is. So I would avoid investing in a business which is planning to grow by taking on more leverage. I think the Tata Group has made it very clear, that they are basically on a deleveraging mode, right? So all expansion will only be made after the balance sheet is substantially deleveraged. So I think, and if you believe that there is confidence that you have that the management can successfully deleverage the balance sheet, then a lot of money can be made, because in the enterprise value, debt shifts to market cap. Just like on the other side, when you are building up leverage and the cycle goes against you, then you see that essentially, debt becomes a larger part of enterprise value at the cost of market cap. So I think when you think about investing in companies which have leverage, you have to be extremely careful. And you have to have the confidence that the balance sheet is likely to be deleveraged. And I think, it's also about how much in your portfolio you invest in these kind of companies. So the trick is, how you manage your risk and how you choose your companies very well. So debt per se is not a bad word. We generally use that as broad guide rails to say that you don't want to buy companies which have too much leverage, because we've seen it in the past that leverage, kills you, because anytime you make a mistake or the cycle goes against you, it takes many, many years, and some companies don't even see the light of the day. But I think where managements have clearly laid down a strategy to delever the balance sheet and the core business itself is doing phenomenally well, then it makes sense, to invest. And also, I think, as I said, it's all about how you build your portfolio, right? You must control your risk within the overall portfolio to see how much or what proportion of these kind of businesses you're going to invest in the portfolio. So I think as long as you can, you can proportion that and manage your risk well, I think there is money to be made there.
Thanks so much for joining us and for really talking to us at length about the kind of opportunities you see in the market at the moment.